If you had invested £1,000 into Rolls-Royce 10 years ago, you would not have become a millionaire. But you also wouldn't have lost everything. And the real result might genuinely surprise you. Back in early 2016, Rolls-Royce shares were trading at roughly 680 pence per share. That means with £1,000, you could have bought around 1,470 shares. Now fast forward to today. Rolls-Royce shares are trading at roughly £12 per share. So if you had held those 1,470 shares until now, your investment would be worth around £17,600. Yes, from £1,000 to over £17,000. But the story isn't that simple. Because over the last decade, Rolls-Royce didn't just steadily climb. In fact, the share price collapsed during the pandemic. At one point in 2020, the shares fell below 100 pence. Air travel stopped. Engines weren't flying. Revenue dropped heavily. The company had to raise emergency funding. If you were holding during that period, your £1,000 would have looked like a disaster. But this is where long-term investing gets interesting. From 2023 onwards, Rolls-Royce began a major turnaround. New leadership, cost-cutting, debt reduction, improved cash flow, strong recovery in global air travel, and the market responded aggressively. The share price surged multiple times over the next few years, pushing it to new highs. Now let's talk about dividends. Rolls-Royce suspended dividends for several years during its restructuring period. However, dividends have now been reinstated. If you had reinvested dividends during the years they were paid, your return would be slightly higher than just the share price growth alone. But the majority of this gain came from capital appreciation during the recovery phase. So what does this actually teach us? First, even famous UK companies can experience massive volatility. Second, long periods of flat or falling performance can be followed by explosive recoveries. Third, timing matters emotionally more than mathematically. If you sold during the crash, you locked in losses. If you held through uncertainty, you benefited from the rebound. But here's the most important point. For almost 7 years of that 10-year period, Rolls-Royce was not a great investment. The majority of gains happened in the later recovery stage. That means patience was rewarded, but only for those willing to sit through extreme uncertainty. So your £1,000 did grow significantly, but it didn't grow smoothly. And that's the reality of many individual UK stocks. They don't compound quietly like an index fund. They move in cycles. Rolls-Royce is a perfect example of how a well-known brand does not guarantee steady returns. It's a reminder that investing in individual shares requires conviction, patience, and tolerance for volatility. And if you're a UK investor looking at stocks today, the real question isn't just, could this double? It's, can I hold it if it halves first? That's the lesson behind the numbers. If you want to see more breakdowns like this on UK stocks and what long-term investing really looks like, make sure you subscribe, because we're just getting started.